Welcome to Indonomics. The June CPI number coming in at a 6.5-year low of 2.1% has led to a few things. One, most economists have revised down their average CPI forecast for FY26, this year that is, to 3.2 to 3.3% against Reserve Bank's forecast of 3.7%. Second, many are penciling in another rate cut. Third, most are not expecting it in August itself. And fourth, above all, bankers and bond dealers are watching Reserve Bank's liquidity policy. How much liquidity Reserve Bank will add or remove from the system and when will determine bond yields and the rate cut transmission. Now, equity investors in banks are still penciling in about 12% credit growth on hopes of a 10% nominal GDP. That may be up for threat. And they're also penciling in an end to the rate cycle. These are what equity investors are penciling in. So today on Indonomics, we have three experts to help us understand how growth, inflation and liquidity may pan out. I have with me Saugata Bhattacharya, Senior Fellow at the CPR, Center for Policy Research, more importantly, MPC member. Neeraj, Gambhir, the Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank, and Samiran Chakrabarty, Chief Economist at Citi India. Gentlemen, good morning and thank you very much for joining me in what's a very crucial conversation. Saugata, first your thoughts on the CPI number, deflation in food inflation and core as well, pretty much under control.
So hi, Latha, thank you very much for having me on your show. So a couple of observations. Yes, the CPI food overall headline and food inflation numbers came in a little lower than what markets had been expecting, but this has begun to emerge as a trend for the last 3 or 4 CPI prints. We have seen this happening. This, to my mind, is very much a one-off. One, as everybody now already knows, I mean, this is partially due to the base effect of a very high inflation print, 5.1% in June of last year. So the next 2 inflation prints are likely to be higher headline prints. Overall, we are in a very good place, very good position in terms of inflation. As you mentioned, I think inflation for the year is likely to be lower than the RBI, the current RBI forecast. So that definitely gives us room, gives room for the RBI, the MPC to continue with the easing cycle. It's just that the pace is unclear. On core inflation, which is what is probably important from a policy making point of view. I think the 4.55% that we have seen in June is likely to peak out, given the fact that base rates, the base effect of core inflation, has been increasing. So I mean, I don't expect a dramatic increase in core inflation, given the fundamentals that are driving core metals prices, commodities prices, etc., seem also to be in a good position. They are very unlikely, particularly crude prices, are unlikely to increase. So I think from the inflationary point of view, I think monetary policy is in a good position. But again, I mean, there are multiple other things to consider.
Okay. Well, Samiran, you're the person in the among the people I spoke to with the lowest inflation expectation for July. Your number is 1.1. So tell us your trajectory. Does it get much below what Reserve Bank has forecast in June?
Thanks, Latha. So yes, we are looking at a 1.5 kind of CPI for August, but this will be which will come out in August for the month of July. But this will probably be the trough on the inflation trajectory. We are now looking at the July-September quarter to be averaging about 1.9%. But at the same time, we think that all the stimulus that is going into the economy, that with a little bit lag will start impacting demand also. So we have actually built in a slightly higher momentum in core inflation for the last quarter of the year. And that's why our last quarter average headline CPI is marginally ahead of the RBI's current forecast at around 4.7%. Altogether, the full year average is about 3.2%. The critical part, which always is very difficult to forecast, is the vegetable price trajectory. But other than vegetable prices, I think most of the non-veggie food prices are behaving in a very benign way. So given how the monsoon has panned out, we think that trend is going to continue as well. So overall, it seems to be, at least in the near term, a very low inflation path that we are going to follow.
Okay. Neeraj, what are the markets expecting from Reserve Bank? If the number, as Samiran is putting it, is going to be 1 point something, maybe even lower than 1.5, will they go ahead and cut despite the neutral stance?
So I think given the inflation outcome and given what Samiran has said, I think the markets are broadly in line with the fact that the next reading is going to be a low reading, but after that we'll see some recovery in inflation numbers, some pull up in inflation numbers. But given the expected outcome on inflation, despite that, I don't think the markets are expecting a rate cut in August, as you yourself mentioned in the initial part of this program. The key reason is twofold. First is that Reserve Bank has already front-loaded a lot of monetary policy action. I think given what they did in the last policy, it was much more than what the market had expected. And I think with that size of monetary policy impetus given, I would guess the Reserve Bank would like to wait a little bit longer before taking the next step. Second is that the action on the liquidity front is also a little bit unclear. There is ample liquidity in the system. There is approximately 3 lakh crore surplus in the system currently. If Reserve Bank does not conduct variable rate reverse repo auctions, then all this liquidity will sit in the SDF, which is where the rate is 5.25. But if Reserve Bank continues to do VRRs and keeps on, it'll effectively pull the overnight rate up towards the repo rate. So currently the market is expecting Reserve Bank to continue with the VRRs and pull the overnight towards repo rate, which basically means that, there is an implied 25 basis point hike in the overnight rates, right? So these are the two forces which are kind of playing out, which is why you're seeing bond market to be very stable at this point in time.
Okay. Yeah, I agree. Moving more towards 5.4, actually, the call rate from below 5.25 some time back. Saugata, I'm going to ask you 2 quick questions because you're not going to be with us after the break. Our discussion will continue. One is, how should central bankers think of inflation? Should they think of the fact that all through 2025, we are going to have 3% or below inflation, which means the real rate is more than 250 basis points? Or should they think of the 1 year forward, in which case 1 year ahead you may have a 4% plus? What should be the standard way of thinking?
So, I think this question has been settled in multiple papers, theoretical, academic discussions, and Samiran put it very clearly that it's not just the next couple of prints, the next quarter. You have to look at it over the course of the year, probably across the cycle. Again, I still go by the RBI's forecast, but even there, it does seem to be on an upward trajectory after, say, from the third quarter onwards. So obviously, this is not. You hear the argument that it's best to cut the policy rate before start with another easing, make another easing move before inflation starts moving upwards. I don't think that's a correct argument because obviously the monetary policy easing cycle, as the name implies, is over the course of the cycle.
Okay.
So you have to consider that. On top of that, you have to look at various other measures which might impinge on core and headline inflation going forward. The inflation growth trade-off, global uncertainty, volatility, etc. So I think caution that I at least particularly keep talking about. I think that needs to be very much in place in looking at the path of monetary policy.
Okay. Let me pack 2 quick questions before you leave us. One, do you personally think that there is space? Because if you look at current inflation, there seems to be a lot of space. If you look at 1 year ahead, you can even argue there is no space. And the governor's statements can be interpreted either way in his interview to me. That one question. And the other one, would growth move the RBI more? And are you worried about growth? in the sense, the WPI number came in at deflation. It came in at minus 0.3. So, is there a growth scare as well?
So again, the growth is definitely the impulses that you see, the data, the high frequency data that you see, definitely suggests that some ambiguity on growth. It's not very clear. I still go by the 6.5%, the forecast for FY26 growth. If we actually do grow at 6.5%, I think we are okay in this current market with the amount of elevated uncertainty that still remains. We have no idea where the overall tariff situation is going, where the trade situation is going. I think we are in a good position in terms of growth. Of course, we need to support growth given the space that the inflation trajectory even over the course of the year provides. But I think at this point in time, as Neeraj mentioned, I think the liquidity support that the RBI has provided, I think that's a far more critical thing in terms of looking at transmission, in terms of credit growth. In terms of credit growth, which is an important part of the monetary policy cycle target, the objective, I need to point out that it's not just bank credit. I mean, the overall flow of resources in the corporate sector, that's very, the amount of money that's been raised to the corporate bond market, I think is very, very high this time and is expected to remain high. Transmission has been faster in the corporate bond market. So, I mean, we need to look at the overall flow of credit, not just from the bank credit side.
Fair point. So you see space for a further fall in rates?
In short, yes. Yes, I see space, but that obviously depends on multiple factors going forward, particularly inflation.
Okay. Well, thanks a lot for that, Saugata. We'll take your leave. Neeraj, Samiran, please stay on. Quick break, and we are back with more questions.